In this video, I'm going to reveal 3 popular ETFs that I would never buy as a long-term investor, even though they're some of the most popular ETFs in the world. Let's get right into it with the oldest and most famous ETF in the world that I would never buy, and that is SPY. Now, this ETF launched all the way back in 1993, and it single-handedly started the ETF craze. Today, SPY is one of the most widely owned ETFs in the world, with more than $660 billion in total assets under management. Now, on the surface, this ETF looks great. You get exposure to 500 of America's best companies. It trades more shares every day than almost every other ETF, which makes it incredibly liquid. And because it tracks the performance of the S&P 500, it has solid long-term returns. If you put $10,000 into this ETF when it first launched, today you would have $265,000. That's a compound annual growth rate of 9.6%, which is a fabulous long-term return. Now, that all sounds great. So why is this ETF on my avoid list? Well, the answer is very simple. Fees. SPY charges an annual expense ratio of 0.09%. Now, while that's very low in absolute terms, it's much higher than the rest of its peers. And those additional fees don't get you anything extra. You're still just owning the exact same 500 companies that you would if you bought another S&P 500 ETF. Now, that difference might sound tiny, but costs compound over time too. So over an investing career, that extra expense can cost you tens of thousands of dollars in lost wealth. That's why my top pick in this category is VOO. You own the exact same 500 companies in the exact same weighting as you do with SPY, but VOO comes with much lower fees. And that's why I would never touch SPY as a long-term investor. Now, as a side note, ETFs confuse you. I created some simple visuals that break down the fundamentals of ETF investing and package the best 10 of them into an ebook. If you want a free copy of that ebook, just visit longtermmindset.co/ETF or click the link in the video description and let me know where to send your free copy. Now, that brings us to the second ETF I would never buy, and that is Vanguard's VUG. Now, VUG is one of the most popular growth ETFs in the entire world, with more than $300 billion invested in the fund. Now, VUG owns plenty of growth and tech titans like Apple, Microsoft, and Amazon. So on paper, it looks like a perfect way to ride the innovation and growth wave. And to be fair, there are some real advantages to investing in VUG. For example, it gives you instant access to over 150 growth-focused companies. It has a 20-plus year track record. And plus, since it's run by Vanguard, it has a very low expense ratio of just 0.04%. This fund also has excellent long-term returns. If you put $10,000 into this fund into its inception in 2004, you would currently have more than $115,000. Which is a compound annual growth rate of 12%, which is a very solid long-term return. So why would I personally never touch this ETF? That's because VUG has dramatically underperformed other growth ETFs over that same time period. As an example, let's compare VUG to Invesco's QQQ, which tracks 100 stocks on the NASDAQ. If we invested $10,000 into QQQ instead of VUG, today we'd have more than $180,000 instead of just $115,000 for VUG. So QQQ has outperformed by more than 2% per year. Now, that might not sound like much, but when you compound that 2% over a period of decades, it results in tens of thousands of dollars. That's why my top pick in the growth category is QQQ. It has much higher long-term returns, which is what you should be after if you're a growth-focused ETF investor. Now, to be fair, VUG also has lower fees than QQQ, but the underperformance of VUG hasn't come close to justifying the small extra fee that you pay for investing in QQQ instead. Finally, let's talk dividends. Many investors love them because they provide steady cash flow, and that's why VIG, Vanguard's dividend appreciation ETF, has more than $100 billion invested in it. But this is the third ETF that I personally wouldn't touch as a long-term investor. Now, VIG does have several positives that explain why it's become so popular. It only invests in companies that have increased their dividends for at least 10 years straight. That means you usually get financially strong and stable businesses. It's also very well diversified with over 300 stocks in one ETF, and with an expense ratio of just 0.05%, it's understandable why this ETF is getting so much attention. VIG also has excellent long-term returns. If you put $10,000 into this fund in 2012, you'd currently have more than $50,000 over a 12-year period. That's a 12.6 compound annual growth return over this 12-year period, which is excellent for a dividend-focused ETF fund. So why would I avoid VIG if I was a dividend investor? Well, the reason is that VIG only invests in companies that have raised their dividend for 10 straight years. And that means it skips out on high-quality firms that may have a shorter history but a stronger payout today. That's a big reason why VIG's dividend yield today is just 1.65% as of the time it's reporting. Other popular dividend ETFs like VYM and SCHD offer yields that are much higher today, which gives you a much more immediate return if you're an income investor. And if you want to focus on dividend investing, the idea of a higher yield is probably far more enticing to you today than a lower yield that you get with VIG. Now, to be fair, if you put $10,000 into all three of those funds in 2011, you've actually had the highest return from investing in VIG. That $10,000 became a $51,000 investment with VIG, whereas it only became $50,000 with SCHD and $48,000 with VYM. So even though it has a lower dividend yield today, it does offer slightly higher long-term returns since it's focused on companies that are growing their dividend, not just companies that are paying a high dividend yield today. But the reason I would still avoid it is that most dividend investors are interested in receiving income today. And with SCHD, you get more than twice the dividend yield today than you would by investing in VIG. I personally don't think that that slight boost in long-term outperformance is worth accepting less than half of the income you'd receive today from buying SCHD instead of VIG. That's why my top pick in this category is SCHD, the Schwab US Dividend Equity ETF Fund. It also focuses on high-quality dividend payers with strong fundamentals, not just those with a long history. But since SCHD offers a much higher dividend yield today, and it's performed just as well as VIG over the long run, it's the ETF that I would choose if I was focused on dividend investing. So here's the big takeaway. Just because an ETF is popular doesn't mean it's the best choice for you. SPY, VUG, and VIG all sound great on the surface, but small details like fees, returns, and current yield can make a huge difference when compounded over decades. By swapping in VOO, QQQ, and SCHD, you'll keep more money in your pocket and give yourself a better shot at long-term success. Now, as a reminder, if ETFs confuse you, I created some simple visuals that break down the fundamentals and package them into a simple ebook. If you want a free copy of that ebook, just visit longtermmindset.co/ETF or click the link in the video description and I'll send it right away. Well, thanks so much for watching this video. I hope you enjoyed it. If you did, give it the thumbs up. That really helps us out on YouTube. If you want to keep learning about investing from here, I highly recommend you watch this video next.